Hello and welcome to this video where we will be exploring several important topics in economics, specifically demand and supply analysis, the firm, objectives of the firm, and analysis of revenue, costs, and profits. First, we will dive into demand and supply analysis, exploring the basic principles of how markets work and how the interaction of buyers and sellers determines prices. This will provide a foundation for our discussion of the firm, where we will examine the key characteristics of firms and their role in the market. Next, we will talk about the objectives of the firm and how firms make decisions in order to achieve their goals. This will lead us to the analysis of revenue, costs, and profits, where we will explore the financial side of firm decision-making and how firms determine their optimal level of production. Demand and supply analysis is a fundamental principle in economics that helps us understand how prices are determined in a market economy. When we talk about demand, we're referring to the amount of a good or service that consumers are willing and able to purchase at a given price. On the other hand, supply refers to the amount of a good or service that producers are willing and able to provide at a given price. As a firm, it is important to understand how changes in demand and supply can impact your business. For example, if demand for your product increases while supply remains constant, it could lead to a rise in prices and increased profits for your firm. On the other hand, if the supply of your product increases while demand remains constant, it could lead to a decrease in prices and reduced profits for your firm. One important thing to keep in mind is that the relationship between demand and supply is not always straightforward. There are many factors that can influence both demand and supply, such as consumer preferences, technological advancements, changes in the economy, and government policies. As a firm, it's important to stay informed about these factors and adjust your strategy accordingly. Demand and supply analysis is an essential tool for understanding how prices are determined in the market and how they can impact your business as a firm. By staying informed about changes in demand and supply, you can make informed decisions that can help you maximize profits and stay competitive in the market. The objective of the firm. The objective of the firm is a critical aspect of business that determines its success in the market. The primary purpose of any firm is to generate profits for its owners and stakeholders. However, the way in which firms go about achieving this goal can vary greatly. Traditionally, the main objective of a firm was seen as maximizing profits. This means that the firm would make decisions based on what would result in the highest profits, even if it meant sacrificing the interests of other stakeholders such as employees or the environment. However, in recent years there has been a shift towards a more holistic approach to the objective of the firm. This approach, known as corporate social responsibility, recognizes that the firm has a responsibility not only to its owners but also to society as a whole. This means that the firm must consider the impact of its decisions on all stakeholders, including employees, customers, the environment, and the community. The objective of the firm is an important aspect of business that can have a significant impact on its success in the market. While the traditional view of maximizing profits is still important, firms are increasingly recognizing the importance of considering the interests of all stakeholders in their decision-making process. By taking a more holistic approach to the objective of the firm, firms can not only generate profits for their owners but also contribute to the well-being of society as a whole. The analysis of revenue, costs, and profits in a firm. Revenue, costs, and profits are three essential components of a firm's financial performance. To effectively analyze these components, it's important to understand the difference between them. Revenue refers to the money a firm earns from the sale of its goods or services. Costs, on the other hand, refer to the expenses a firm incurs in order to produce and sell its products. Finally, profit is the difference between revenue and costs, and represents the amount of money the firm is able to keep after accounting for all its expenses. To analyze the performance of a firm, we need to understand how revenue, costs, and profits are related. If revenue is greater than costs, the firm will generate a profit. If costs are greater than revenue, the firm will incur a loss. The key to maximizing profits is to increase revenue while minimizing costs. One important tool for analyzing revenue, costs, and profits is a profit and loss statement, also known as an income statement. This statement provides a snapshot of a firm's financial performance over a given period of time and includes information on revenue, costs, and profits. By analyzing this statement, we can see how the firm is performing and identify areas where improvements can be made to increase profits. Revenue, costs, and profits are critical components of a firm's financial performance that must be analyzed in order to make informed decisions. By understanding the relationship between these components, firms can make adjustments to increase revenue and minimize costs, which will help them achieve the ultimate goal of maximizing profits. In conclusion, this video has provided an overview of several important topics in economics, including demand and supply analysis, the firm, objectives of the firm, and analysis of revenue, costs, and profits. By understanding these concepts, you will have a deeper understanding of how markets work and how firms make decisions, which is crucial for anyone studying economics, business, or related fields. Thank you for watching. We hope you found this video informative and educational. If you have any questions or comments, feel free to leave them below. And don't forget to like and subscribe for more economics content.